Hello, I'm Finola Burke from Research as a Service, and today we're focusing on data and insights and media company Pureprofile. I have with me Managing Director Martin Filz and COO and CFO Melinda Sheppard. Thanks both for joining us.
Hi, Finola.
Hi, Finola. Thanks for having us.
I'll start with you, Martin. Now, you've reported a 39% increase in revenues in FY22 and the company's first normalised net profit. Congratulations. All while investing in additional people and geographies. What can we expect from Pureprofile coming into FY23?
Yeah, thanks for the question, Finola. Look, delighted with the growth. I think last year we had about 24% growth year over year, 39% growth. Actually, it's the largest growth that we've ever had year over year as a company in 24 years now. So really pleased with that. I think moving forward, as we expand more internationally, we've got a number of new people that we've added around the world, salespeople, commercial roles. We will see that number come down. 39% growth is actually high, and it's high for any company to sustain. So as we are more mature, as we've got more of the existing growth, then we'll see that number come down a little bit. To a more sustainable number that we are comfortable with growing from strong base with.
And now Pureprofile added $1.7 million in cash to its balance sheet across the year to end with $5.3 million in gross cash and $2.3 million in net cash. Do you feel positioned to consider acquisitions in FY23? And if so, where do you feel Pureprofile has some gaps in its business?
Yeah, great question. So we are absolutely considering acquisitions at this point in time. We've very openly stated that's part of our strategy moving forward. I think when we think about acquisitions for Pureprofile, we want to make sure that any organisation that we look at acquiring is going to bring us either a combination of people, so bringing new great talent into our organisation, panels, so really allowing us to grow our panels globally. And also we like to see some profit. So, what's really important to Martin and I is obviously making sure that we're growing our bottom line and that we're remaining operating cash flow positive. So when we're looking at organisations, we're looking for those three things and making sure that we're, buying something for the right price and that we're going to really get the benefit of those acquisitions moving forward.
Thank you, Mel. And Martin, you have a target to get offshore revenues to above 50% of total. I think in FY22 you were above 35%, which is a great result. How do you see that progressing over the next couple of years?
Yeah, one of the other trends that you're seeing, just the report that we just released, is overseas we grew 50% and in Australia we grew about 22%. And so that trend continues. If you look at new heads that we've added just in the last quarter or so, new head of sales, India and US, and he carries a quota, Ashish Pandey, a senior account director, UK, head of sales, UK, also carrying a quota, and then a senior account director in Australia. So that's a 3-to-1 ratio of adding heads in the UK and US and adding heads here in Australia. So I think we'll see that 50% level be about the same growth. I think we'll see the 22% come down a little bit for the Australian growth. And the reason is simply that we've done less investment in Australia and more investment internationally. And that's our plan. That's been the strategy for the last 2 years and is paying fruition as we add those investments.
And Mel, UK Group YouGov has often been cited as a benchmark for EBITDA margins for the industry. It's been sitting around the mid-20% the last few years and has been as high as 30% in the past. Where do you see the tipping point for Pureprofile to get the same sort of operating leverage?
Yeah, so another great question. So when we think about improving our margin longer term, and obviously we've told the market that we're expecting our EBITDA margin to be maintained in FY23, predominantly because of the investment we're making. We also talked a little bit about what our third stage of our corporate strategy is, really around end user or end client technology solutions. And we really think that once we sort of start moving into stage 3 of that corporate strategy, that's when we'll really start to see that those margins more aligning to our peers such as YouGov. So looking at FY24 onwards, starting to rebuild that EBITDA margin.
The other thing to add on to that quickly, Finola, is when you look at financial year 21, we had EBITDA margin of 5%. Last year, 20 was 5%, 21 was 7%, 22 was 10%. So we're making progress to head in that direction. Also, the other interesting statistic, when you look at our NPAT numbers, we're again moving towards NPAT profitability. So not only cash flow profitable, which we've been for about 7 quarters, EBITDA margins growing, but also about 3 years ago, we had close to $6 million, higher.
9.7 million.
9.7 million negative NPAT. Then last year, ignoring the year before last, ignoring the debt forgiveness, was about
6.5 mil.
And then it came down to 2.2. So we're seeing all of our metrics and measures head the right way, but the main one that we look at the moment is cash flow positivity.
Well, thank you so much for your time today, Martin and Mel. Looking forward to checking back in with you through the course of FY23.
Wonderful. Thanks so much, Finola.
Thank you, Finola.